Hello everyone, I'm Mark Sane and welcome to Sane Investment Solutions. Please take a moment to pause this video and review the following disclaimer. Thank you for that. Welcome to week 5 of the Forex market review. Today we're going to take a look at the daily FX news just to see the news for the current week which has occurred and what's coming up for the remaining part of the week. As well, we're going to take a look at the pound yen, one of the charts that we looked at last week, just to see where it went and how it delivered on our trade example. We're also going to take a look at the USD yen and how it may be affected by the upcoming news this Friday for the Australian Eastern States time. So here we have is the daily FX calendar. What you need to do is just filter on the high important news only, and then change your GMT time to your local GMT time, and we're using +11 for Eastern States in Australia. What we have it on is a weekly view, so we can see what's happened in the beginning of the week and what's going to happen towards the end of the week. At the beginning of the week, we had the China manufacturing PMI numbers. This number came out slightly worse than expected, and therefore, if you're trading such currency pairs as the Aussie USD, you would have seen a bit of weakness on the Aussie there. Moving along on Tuesday, February the 2nd in Australian Eastern States time, or GMT +11, around about 2:30 in the afternoon, Australia had its interest rate decision come out. They left interest rates unchanged at 2%, with the forecast being 2% and the rate being 2%. They've left rates unchanged, however, they did indicate that it's likely that they would make a decision on what they want to do down the track if it's required to. So a lot of about 85% of market analysts are predicting a rate decrease in Australia by October 2016. So therefore, you're probably going to see some further downside weakness on the Aussie dollar. Moving along, we had some European unemployment numbers coming out. They came out slightly less at 6.2% versus 6.3% expected. And early hours of this morning, we had the New Zealand unemployment rate numbers coming out at 5.3 versus 6.1 expected. So that was pretty good numbers for the New Zealand unemployment rate, dropping a little bit down to 5.3, and where they expected to go up a little bit. So those numbers would have seen a bit of strength in the New Zealand dollar this morning. Coming up later on tomorrow, on Thursday, February the 4th, at roughly 11 o'clock at night, Australian Eastern States time, we're going to have some England interest rate decision come out. They're looking at leaving rates unchanged at 0.5%. So if rates remain unchanged at 0.5%, then we're likely to see the English pound probably strengthen a little bit, or likely fall backwards. It all depends on the market sentiment and whereabouts the pound is at the time of the announcement. It's not just looking at the interest rates being left on hold, it's more about where they believe the interest rates may go in the future. And at the moment, the prediction is that the market may see an increase in the pound sometime this year. And one important news coming on later towards the end of the week, being the early hours of Saturday for the GMT +11, we're going to see the US change non-farm payroll numbers come out. So last month they were 292k, and this month they're expecting to be a bit less at 190k. So if we can see any numbers over 200k, we're going to see the US dollar increase in value, and any numbers below 190, we're going to see it decrease. So the outlook is to probably be above 190, but we have seen some weaker numbers in the US recently, so we would like to see a good number and get another bounce higher on the US dollar. So here we're looking at the pound yen on the daily chart, and last week we're looking at the pound yen and we're looking at a pullback for a possible wave 4 on the daily chart. So what we had our Fibonacci retracement indicator on here, and round about down these levels we're expecting a pullback of roughly around 38 to 50%, and what we can see is actually pulled back roughly around that halfway point. So if you're looking at trading that one and you're able to get into the market, then you would have made some good result at this early stage. What we then can do is drop down to the 4-hour chart, and what we want to do is just put our fib expansion tool just to see where the market was going to go. So my understanding is we're looking at the market to pull back for entry, and we're going to look at pulling back to around these levels here, getting in for a move higher. So if we look at the market, we would have looked at a fib expansion tool, and we would have tried to made an assumption of roughly where we think it could go. And the fib expansion tool is a good tool to use so that you're taking emotion out of the trade and you're using your technical setups to see where the market could go. And as we can see, if we entered the market, we would have delivered easily to the fib expansion 100% level. Now these results were quite good because the market moved quite heavily as the yen announced a decrease or a negative cash rate. So this was a surprise to the market, and as the negative cash rate occurred, we would have seen weakness in the yen, which means strength in all the other currency pairs. So that's why we would have wanted to take a trade long. And if you're long the market just based on the technical trade and this announcement came out, then that definitely delivered for you. So this was the trade set up here, where we had on a 1-hour chart. So on the 1-hour chart, we would have seen wave 1, pull back for wave 2, and a wave 3. So as the wave 3 moved higher, we then had a pullback for wave 4, looking for our entry signals. So on our entry signal on a wave 4, we're looking for that pullback roughly around the 50% fib retracement level. And the reason why we use the fib retracement level 50% because we've got to make sure our risk to reward is correct. So roughly around 50% we would have taken the trade. So around these levels we would have entered the market and we would have looked for that move higher. So we would have had our stop loss somewhere down here. You might have had about a 200 pip stop loss, and you would have been looking for about 400 pips, and you easily made that even if you're going for 600 pips, which is a 1-to-3 ratio. You could have had a larger stop loss there, and you could have done other things, but if you were going for a minimum of 1-to-2, you definitely did deliver. We then use our fib expansion tool, and that's just where we go from the recent lows to the recent highs and back to the recent lows again. And as we can see, we would have exited around these levels here, and that definitely delivered on time. So if we entered here and had our 200 pip stop loss, up at those levels was 540 pips. So going for 1 to 2.5, we would have got out about 500 pips, and this great move here would have got us out on that. So that announcement by the yen having a negative cash rate definitely would have serviced this trade and delivered quite well. We're now going to take a look at the USD yen, and we're looking at the USD yen based on the market news coming up, and that's because the US news coming out. So we're going to see the market go in some type of direction. So this USD news coming out, we're going to either move higher or lower depending on the numbers. But what we want to look at is just support and resistance areas. So if we took our tool, just a horizontal tool, and we just drew in our support and resistance areas, you can roughly see there's some resistance roughly around these levels here. And all we're doing is we're just using our tool just to see where it's bounced a few times, and we're just drawing those horizontal lines in. And if we can draw one down the bottom here, it doesn't have to be perfect. We just want to have a rough example where it's been. As we can see, it was in a channel for a while, and then it broke out to the upside, and then it broke back down to the downside. So we're not quite sure where we could be in the market at the moment. This could be another move lower with a pullback higher. So if we class this was as a wave 1 for pullback for wave 2, then we could be seeing a move lower. And definitely if the USD news is not good, we're going to see it move higher. However, if you under the assumption that this is a move higher, then you would be looking for a pullback lower. So if we drop down to the 4-hour chart, we could assume that this move here, or this large AO being the first one, is the wave 3 higher. So if we took that as the wave 3 higher, we can draw in our rules and we can say to ourselves, well, this is possibly wave 1 starting down here. Then we're going to have a move up for wave 2, which would have been around about these levels here. Wave 1 and 2 is pretty hard to see, but we definitely can see wave 3 because that's our first largest AO, or the MACD, depending on what type of tool you like to use down this level. This large move here is wave 3, but it's not really confirmed ending until it's come back below the 0 line. But let's just assume this is the pullback for wave 4, and a lot of times we've got to take this assumption early. What we want to do is put in our fib retracement tool. We want to take from the recent lows to recent highs and then back again, and we want to look at entering around the 50% level. You could say, oh, why not I get in at 38.2% level because we think the news is going to be good. By all means you can do that, but the news is still a few days away, so it's likely the market might rebound up and then fall back lower. But the main reason we don't take it at the 38.2% level is the risk to reward, because if we're going to go up to recent highs, which is the first place it could stop, plus the daily support resistance area, we're looking at around 170 to 200 pips. Now if our stop loss is around 200 pips, we're going to only make 1-to-1 risk to reward, so that's not enough for us. The reason why we want to take our trades round about down these levels, or even off a bounce off the recent support areas down these levels here, you could look at re-entering if it was to bounce around these levels here. Then you could put your stop loss around 200 pips, knowing that you can get out for probably almost 1 to 1.5. So looking at taking a trade roughly around these levels, push back higher. And definitely if the news is positive, we're going to see that rally higher. And if the news is negative, it's going to rally lower. But we're unsure which way the market will go on those news. We can only take an assumption of where we believe will go and look for our technical view. However, if you're under the assumption that you're fundamentally long the US dollar and the shorting the yen, and with the yen being weak and the US dollar being long, then by all means you'll be looking for these pullbacks so that you can take the move back higher. And thank you for reviewing the week 5 of the Forex market review. It was good to see that one of our predictions, the pound yen, actually did deliver on its trade setup, and with the help obviously with the yen having a negative cash interest rate, then that definitely allowed weakness in the yen and allowed our pound yen to move higher. If you would like to get some additional information and some additional videos, by all means please register at the register now button, and then go ahead and provide us with your details, and we'll be more than happy to send you some additional videos. For members who have registered, they're the ones that will be entitled to additional videos which aren't provided free to the other members. These are for registered members only, and registration is free, so you can register at no cost. And we provide information on understanding Fibonacci expansion and retracement, as well as understanding divergence. And these are helpful tools and videos to get you to understand how we are taking our trade setups and looking at where the market may deliver to. Thank you. I wish you all the best to your success. Take care. Bye-bye.